If you want to invest but don't know where to start, and every explanation you hear just makes it more confusing, you're in the right place. Because most people don't need dozens of investments, complicated strategies, or perfect timing. They need three things that quietly cover almost everything. In this video, we'll walk through the three investments almost everyone can start with, why they actually work, and how they fit together without overwhelm.
We'll start with broad market stock ETFs and why diversification matters more than picking winners. Then we'll talk about bonds or bond ETFs, not for exciting returns, but for the role they play. And finally, cash and why holding cash is still an investment decision. At the end, we'll show how these work together based on your risk tolerance.
Let's start with stocks, but not individual stocks. We're talking about broad market stock ETFs. These funds own hundreds or even thousands of companies at once across different industries. Instead of trying to guess which company will win, you're betting on a much simpler idea that businesses as a whole grow over time. This matters because most beginners think investing success comes from being right, picking the right stock, timing the right moment. But long-term investing has usually been more about participation than prediction. Some companies will fail, some will struggle, others will grow massively. A broad market ETF adjusts automatically. Winners matter more over time, losers matter less. That's diversification doing its job quietly in the background. Now, stocks do move around a lot in the short term. That's normal. Volatility isn't a flaw, it's the price you pay for long-term growth.
Next up, bonds. Bonds are not exciting, and that's exactly the point. When you buy a bond, you're essentially lending money and getting interest in return. Bond ETFs bundle many of these together. The role of bonds isn't to beat stocks, it's to reduce stress and smooth the ride. Bonds tend to move less than stocks. They can help absorb shocks when markets drop, and that matters more than most people realize. For many people, bonds exist to prevent panic. They make it easier to stay invested when things feel uncomfortable. If stocks are the engine, bonds are the seatbelt.
Now let's talk about cash, the most misunderstood one. Cash doesn't grow fast, but it does something incredibly important. It gives you stability, flexibility, and peace of mind. Cash helps you handle emergencies without selling investments at the worst possible time. It gives you room to breathe when markets are volatile. Yes, cash can lose value to inflation over time, but that doesn't make it useless. It just means cash has a different job. Without enough cash, every market dip feels urgent. With it, long-term decisions become much easier.
Here's the big picture. Stocks drive growth. Bonds reduce volatility. Cash gives you control. The right mix depends on your risk tolerance, not on someone else's strategy. There's no perfect setup. The goal is simple. Build something you can stay consistent with.
You don't need to rush. You don't need to optimize everything. You're not behind. You're just underinformed. Simple beats perfect. If this helped, subscribe for calm, clear money guidance and share it with someone who's stuck overthinking where to start.
Hey, we're the money-wise couple.
We're not financial advisors, just a regular couple who
Paid off our debt, invested our money, became financially independent.
and we're here to help you do the same.